All right, thank you everyone for joining us for introduction to high probability option trading using Elliott wave analysis and volatility analysis. My name is Michael Golembesky. I am a senior analyst at ElliottWaveTrader.net. My primary focus is on the U.S. equity markets and volatility markets. I also host a trading service at ElliottWaveTrader.net. I am a syndicated author on MarketWatch, Seeking Alpha, as well as NASDAQ.com. My colleague Lou Alfieri is going to be joining us as well. I'll let him do his introduction a little bit later in the presentation as we get down to his section. All right, so in this presentation, I'm going to discuss how to identify high probability trade setups using Elliott wave and volatility analysis. I'll explain how to maximize gains while managing risk using very simple option strategies. By the end of this presentation, you should have a basic understanding of how we use Elliott wave analysis to identify high probability trade setups and how to maximize gains while managing risk using those simple option strategies. So the method behind our analysis is Elliott wave analysis, and we use this to analyze U.S. index and volatility charts. Elliott wave theory postulates that social mood is driven by unconscious and endogenous forces that fluctuate in repetitive and fractal patterns. Periods of positive social mood result in rising stock market and economic expansion, whereas periods of negative social mood result in declining stock prices and economic contraction. Social mood follows repetitive and predictable patterns that can be measured and tracked using financial markets. Fluctuation of stock prices is the result of changes in that social mood. We can measure and track social mood by applying Elliott wave analysis to the charts of freely traded financial instruments. So the basics of Elliott wave pattern are the market progresses unfolds in waves. The trending moves unfold in 5 waves regarded as impulsive. Counter-trend interruptions unfold in 3 waves regarded as corrective. Impulsive structures are labeled with numbers, while corrective structures are labeled with letters. So we have an impulsive wave structure here, 1, 2, 3, 4, and 5. Corrective wave structure here, A, B, and C. On top of our basic Elliott wave patterns, we also use Fibonacci pinball, and we use Fibonacci expansion and retracements to help identify our price target levels, our price retracement levels, our resistance levels, and this allows us to enter price setups with predefined targets, resistance levels, and support levels prior to entering any trade, which allows us to have predefined levels of targets as well as support levels before we enter any particular trade. And this is a key advantage to our analysis method. So Elliott wave has certain characteristics and personalities, and each wave will display their own unique personality and characteristic. These wave personalities can be useful in trading and especially helpful when trading in options, and we'll get into that a little bit later in the presentation. So the characteristic of the wave 1 is it's considered the initiation wave, meaning that it begins the impulsive structure of our 5-wave sequence. During this wave, prices will begin to bounce higher after a sustained downtrend in the markets. The sentiment in the market is typically bearish at the start of this wave, and the fundamental and economic news is predominantly negative. As the wave 1 moves higher, most people see this upside price movement as just another bear market rally, and many investors and traders consider wave 1 as a good opportunity to initiate a new short position or add to their existing short positions. Wave 2, as the market moves lower, most traders will continue to add to their short positions and remain bearish. The news at the end of the wave 2 swing low is often more pessimistic than the start of the wave 1. Most traders are not prepared for the eventual turn in the market, which will begin to lead prices higher. Those who are prepared are usually well rewarded for recognizing the extreme pessimism and oversold market condition. Once all these sellers have placed their bets, there's nowhere else for the market to go higher in the wave 3. And the wave three offers the largest potential for profit, as it usually is the biggest and most powerful wave within the overall Elliott wave structure. Although many of the earlier bears will still resist the optimistic outlook during the early stages of the wave three, it will become increasingly evident to most traders that the tide has shifted and the markets are poised to move higher. Upon the break of the swing high of the wave one here, prices will begin to accelerate upward and more traders will recognize the bullish sentiment and start taking long positions. Additionally, many bears have their stops triggered at the swing high, the wave one swing high here, which adds further fuel to the upside as short squeezes begin to happen at this point. Wave four is often seen as the profit-taking wave. During this wave, most traders that have jumped aboard early in the trend on wave three are taking a good amount of profits at this point. Many of these traders will begin to liquidate their positions and lock in profits. This can result in sideways price movement that lasts for an extended period of time. Wave four brings with it whipsawing price action that often generates false breakouts on either side of the market. And this is one of the most difficult waves to trade. And it's one of the structures that we tend to stay away from when trading. And wave five is the final leg within the Elliott wave impulsive wave sequence. The momentum behind the bullish activity in wave five will be less dynamic than during the wave three progression. The velocity of the price movement will be more subdued than is seen during the wave three. It's during these late stages of the wave five, we will also see technical divergence patterns form between the price and the technical indicators. So that's the basic of the Elliott wave theory. So this is the Elliott wave in action. This is a chart that began from the 2003 low. And we can see this is an actual chart pattern following our Elliott wave pattern. So we have our wave one, our wave two, our wave three, our wave four, and our wave five. And we can also see our Fibonacci levels here. Our wave one is where we start our Fibonacci extensions. And we have our retracements as well. And we retrace this wave two right into our retracement zone at the 38.2% to 76.4% retracement. This is the standard for wave two, and we see that this wave two fell right into that region. We have our wave three, which hit the 176.4 extension of the wave one. So wave one, two, three, right to that target zone. Our wave four held over our support level of the 100 extension, and our wave five ended in the 200 to 261.8 extension of the wave one. These are all standard Fibonacci pinball levels for our Elliott wave impulsive wave sequence. In this particular example, we can see that this played out fairly well to the upside in this Elliott wave sequence after a sustained move lower in the NASDAQ starting at the 2002 low. And so this is another example of Elliott wave in action. So again, this is the NASDAQ again from the 2002 low. We can see that again, Elliott wave is fractal in nature. So we have our initial wave sequence here, our wave one, and then we have a larger wave two down in this region here in the financial crisis wave two. So again, very bearish sentiment down in the 2008 low. And then from that point, we saw a sustained rally that we're still experiencing the final stages of that rally to this day. So that was the financial crisis low in 2008. Again, very bearish sentiment at this point in time before the market had its sustained move to the upside again to current times that we're in. All right, so this is again an example of the Elliott wave personalities. Again, we can see 2002 low, the sentiment was very bearish at the start of this wave one. The fundamental economic news was predominantly negative at this point in time during the dot-com kind of bust in this region. And at this point, we saw a wave one, two, three, four, five wave move up into the 2008 high, and then a sharp move lower into the financial crisis. Again, very negative news at this point in time. And then we saw the market continue to move higher into, again, 2024, 2025, where we're currently sitting. And again, Elliott wave is fractal nature. So we see this impulsive wave structure here. Five-wave move up has several five-wave degrees inside of it. So 1, 2, 3, 4, and 5. Within each five-wave structure is another five-wave structure, and each of these five-wave structures inside of the larger degree five-wave structures are tradable. And this is what we're looking for when we look for tradable setups. We're looking for those five-wave sequences within the larger degree five-wave sequences. Okay, so Elliott wave and volatility. When we trade volatility and analyze volatility, we primarily apply our Elliott wave counts on the volatility exchange traded products, specifically the VXX. We use the volatility charts to allow for both trade setups on those charts directly, and we also use volatility analysis to help confirm what we're seeing on the equity charts and gives us a higher level of confidence in those particular accounts. This can be especially helpful when volatility and equity charts diverge. If we're seeing something different on one chart versus the other, it can give us a pause and have us may take a pause at a particular trade setup. I want to wait for more clarity, and this is something that we use quite a bit in our service. This is an example of the VXX. This is a chart to the downside, and again, we can see our wave count on the VXX. So we've got 1, 2, 3, 4, and 5. And again, within this wave structure, we have 1, 2, 3, 4, and 5. All this following our Fibonacci pinball guidelines fairly well here. We have our wave 3 hitting right between the 176.4 and 200 extension of the wave 1. We have our wave 4 retracing up towards the 100 extension, and our wave 5 hitting the 238.2 extension of that wave 1. And these are all pretty standard levels for the VXX. Volatility charts have a little bit different Fibonacci pinball structure than we see in equity charts. They tend to extend a little bit further just due to the nature of the product and the extremes of volatility. But again, this is following a Elliott wave Fibonacci pinball sequence fairly well here. And this is how we apply Elliott wave analysis to the volatility charts. Again, same basic pattern, same rules apply to the volatility charts as the equity charts using our Elliott wave analysis. So in our service, we use primarily options when we're placing our trade setups. And so just a quick basic overview of options. An option contract is a contract that gives the buyer the right, but not the obligation to buy or sell the underlying asset at a specified price on or before a certain date. This contract will rise and fall in value based on a number of factors, but is usually most heavily affected by the price of the underlying instrument. Option buyers will pay a premium for that option contract based on, again, a wide variety of factors, including time and the overall market conditions, the volatility of the overall market. Options can either be exercised at a point which the owner of those contract will be assigned the shares of the underlying instrument, or the option contract be sold for a greater or lesser value than the original purchase price. So some of the pros of using options, the risk can be very well defined ahead of time. So we're able to identify minimum and ideal targets, again, well in advance. We can see outsized returns often in options based on the nature of the instrument, and they work very well in conjunction with Elliott wave analysis. Some of the cons of using options, both price and time must be factored into the trade. You can lose all of the premium paid for the option contract. It can be tempting for traders to gamble with the potential outsized returns that are often seen trading options. But to succeed consistently, traders must be able to defy the expectations of the seller of those options, and they need an edge to do that. And that edge is Elliott wave. So the most common trade setup that we're going to be looking for in an options, when we're trading an options contract specifically, is we're going to be looking for that wave 2. Again, if we remember the personality of that wave 2, the wave 2 personality is that the market will continue to move lower as traders continue to add to their short positions and remain bearish. So at this point in time, option premiums are usually the least expensive. This is when the premium of the options is lowest. So we're typically looking to buy an option contract at the bottom of a wave 2 or during a wave 2. Again, the news at the swing low of this wave 2 is the most pessimistic, even more pessimistic sometimes than the start of the wave 1. And most traders are not prepared for the eventual turn that the market will see in the wave three. And again, those who are will be well rewarded, and option contracts can allow for a great increase in value during this wave three. And this is where we, as experienced Elliotticians, start to execute our option trading plan. So in our service, we provide trade setups primarily in the index, ETF instruments, the SPY, QQQ, IWM, as well as the VXX. We highlight optimal option strikes. We give guidance throughout the trade. We don't overload traders with setups and have a goal of 3 to 4 high probability setups per month. And this is an actual trade setup that we executed using Elliott wave analysis. So this one here is the SPY. It's a 3-minute chart. So this is a shorter time frame chart. And during this point in time, we saw that there was a corrective retrace that moved back into this region here. And then we saw a 5-wave move to the upside here, which we labeled wave 1/A. We looked for a corrective retrace for wave 2/B here. And again, our retracement zone at this point was 61.8 to 76.4 retracement of this wave 1. And what we were looking for is we were looking for a wave 3 to begin at this point, targeting our 138.2 to 176.4 extension to give us a profitable trade setup on this. And using options, what we're going to do is we're going to lay out several different strikes on this particular trade. We have different expiration dates that we're looking at. We're looking at different strikes. And when we're trading this call, what we're looking for is we're looking for a move to our ideal target, which is going to be our wave 3 target here. So our ideal target for the wave 3. We're looking for a minimum target for a wave C. So we have 2 target levels that we're looking for. And our goal is to always get 100% gain on that option premium at our minimum target. And typically somewhere between 300 and 600% at our ideal target. So this is the gain in value of our option contract. And that's the goal that we're looking for when we place these option trades. So again, just looking at that particular example again, we can see we have our 1-2 setup here, right into support. We have our option workup here is what we call it. And we're looking for a maximum gain at 552% at our ideal exit price, which is going to be 476, which came in right at the 161.8 extension here. And our minimum target is going to be coming in at the 472 level, which is right at the 100 extension. And the reason why we use this 100 extension is because this is the level at which we see a lot of resistance happen. So when we're having a Elliott wave structure, when we're in this 1-2 setup, we don't necessarily know if this is going to turn into a corrective wave structure when we're placing the trade. So oftentimes we'll see at 1/A, 2/B, and we'll see a C wave stop right at this 100 extension. So when we're identifying trade setups, we always want to see if we can get a 100% gain on our option premium at the 100% extension of our wave 1, in case this turns into a C wave or a corrective wave structure and does not follow through as an impulsive wave structure. So we're always identifying risk ahead of time, and we're always trying to still allow profitable trades, even if the trade doesn't follow through exactly as we had expected when we entered the trade. So in this particular case, we can see that we did see follow through on this particular trade. We moved through that 100 extension here. So this was a good indication that we were indeed seeing an impulsive wave structure to the upside. And at this point, we were moving into our target zone for our wave 3. We were able to take profits at this point, and this was a successful trade in our service. So again, at the bottom of this corrective wave structure in our wave 1, again, our personalities, the sentiment of the market is typically bearish. Economic news is negative. People are still expecting the market to continue to move lower. The top of the wave 1 and then the retracement of the wave 2, we see that people are still pessimistic at this point. This is where people are adding short positions. They're looking for the market to continue lower, continue this trend that we were seeing down over here. And in this particular case, we saw the market defy that expectation and move sharply higher. And again, we identify this with an Elliott wave within the structure of these moves here. So this move here, we identified a 5-wave structure. We would zoom into this a little further. You could have seen this was a 5-wave structure to the upside, and this was a corrective wave structure, a 3-wave structure to the downside, which allowed us to identify this particular trade setup. And again, the market shot higher in this particular example. Again, moving through our 100 extension, our minimum target here, and up into the target zone for this wave 3. Okay, so risk management is something that we really strive to emphasize when trading, and this is something that a lot of traders struggle with. But it's by far the most important aspect of being a successful long-term trader. You can identify the best setups, have a very high hit ratio on your setups, but if you don't manage your risk properly, you're not going to be successful at trading. And this is something that we really try to emphasize in our service and really work hard at teaching people how to manage risk properly. This is especially important, again, using options, because you can have the temptation to gamble when you're seeing outsized returns time and time again. So risk management is extremely important when trading, especially trading with options, but just in trading in general. So the way that we look at risk management is, because Elliott wave gives us an edge, we utilize an all or nothing type of approach in regards to trading options. What this means is that when we buy an option, the premium that we pay for that option is the total risk of that particular trade. So whatever you want to risk on your total account, you buy that amount of premium. So if the option goes up 300%, then your account percentage the gain of your account is going to be the percentage you risk times 300%. If the trade doesn't work out, you're going to lose whatever that percentage risk is. So 100% of that percentage risk. So for example, if you were willing to risk 2.5% of your trading account value per trade, then the option contracts that you would buy would equal that value. So the total risk of that particular trade would be 2.5%. If you had a 300% gain, then you would earn 7.5% of your account value on that one particular trade. Again, if you lose on that particular trade, you're losing only 2.5%. So if the option contract goes to zero and the trade doesn't work out whatsoever, your risk is defined ahead of time, and you are limited on your downside, regardless of what happens in the market. So you could see a market crash 10% overnight. It wouldn't affect your risk, which was again defined ahead of time by the price that you pay for that option contract. And these numbers, of course, can be modified based on your own personal risk profile. We have lots of different types of traders some people risk 0.5%, some people risk up to 5%. It really is dependent upon your own personal risk profile, what you're trying to achieve, what type of account you have. But again, these numbers, again, can be modified. But what we do recommend is that whatever you decide to risk per trade, that number stays fixed as a percentage as you move through your trading system. Starting to modify these percentages is where people tend to get into trouble. So we always recommend to pick a number that you're comfortable with and stick with that number over the longer period of time. And over a long period of time, this is where you can be successful trading this system. And it is a great way to mitigate overall market risk, as you're not risking an entire portfolio or a basket of instruments in the event of a large downside correction in the market. All right, so that's kind of the basic overview of the risk management in our system. What I like to call advanced risk management would be a more recent addition to our service, which Lou will get into shortly here. And again, our system offers really one of the most risk-averse ways to trade the market. Again, by committing only a fixed percentage of your account to any single trade or investment, your potential loss is limited to just that portion. Again, so even if the market moves sharply against you, your downside risk is limited to only what you decided to risk ahead of time and bought in option contracts. We've had hundreds of traders find a lot of success using our system. And but we have noticed that new members still struggle with the concept and often risk too much capital. So to address this, we brought on Lou Alfieri to better support risk-averse traders who make up a large portion of our membership. And we recently introduced a new system led by Lou, who has successfully grown his account over the past 6 years within the service. Lou's here to help accelerate the learning curve to newer folks. And Lou not only educates members, but also shares his exact trade plan, how he allocates capital, and his guidance helps build new and experienced traders follow our system in a clear, effective, and very disciplined way. And I'm very excited to have Lou into the service, and I'm going to let Lou take over from here and go over a little bit more about his advanced risk management system. So Lou.
Yep.
Go ahead.
Hi, everybody. I'm Lou Alfieri. I'm an analyst, and I work with Mike in the VIX trading service at Elliott Wave Trader. I'm a JD. I also have a master's degree in physics, but I'm a lot older now, and I've been doing this and enjoying this a lot more. And that's what makes me risk averse. So I provide members with a simple approach to trade the entries and exits based on Mike's trade setups. If you recall from what he showed, Mike will show a workup sheet that has three different expirations with different strikes to choose based on your risk profile and your risk tolerance. So all I've been doing over the years is choosing contracts and managing them in a more conservative way than Mike does. And I'm not alone. There's a group of us who have been trading with Mike for 6 years, and we have done phenomenally well in his service. I've tried a lot of services, and this is the most consistent way to make profits that I've found anywhere. And there are a bunch of members that do that. And I would say humbly that we're all in the more conservative bracket. So I've written down on paper the strategy that I use based on my experience with Mike's trades. And there's nothing magical about the risk management techniques I use. A lot of it can handled through sizing, taking on some extra time if it's warranted, and you can get enough returns, and tranching in and out of positions. So, and I'm very hands-on about it because Mike brought me on just to make sure that everybody was having the same success as the main group of traders in his service was, and as he was. And there were just some traders who were just not doing it. And I truly believe that that greed is just a very powerful emotion. And what I provide is consistently, there's no rule breaking here. And like I said, the rules are on paper. So that's the reason I think many members struggle with the all or nothing nature of options trading. I think they'll have a couple winners and they'll put a lot into it, or they won't be paying attention to the size of their account or where they are in their life. And Mike and I take them through all that, and so that their account can survive, 7 losses in a row if that were to happen. I mean, the way I run the system, you can survive 20 losses in a row, more if you're changing the percentage of your account as you go, which helps you as you grow. But I'll get into more of that later. So basically, we just use longer dated options. We take profits early. I'll explain why in a minute. And sizing takes care of the rest of it. So what this approach does is because we take profits early, there will be times when Mike outperforms us. So the conservative approach, I would have to say, does underperform just flat out copying me. So why do it? Well, because what I do limits the drawdown. I don't like to see red at all. I like my account to start off green, keep growing, and sure, there are going to be losses. But the trick is to survive the losses because you want to catch the 600% winners. And I'll show you how that happens on the next slide. But basically, if you're running a small account, this is a great strategy for you. If you're retired, this is a great strategy. Or if you're just risk averse, this is a great strategy. When I started with Mike, I had a small account and I've doubled that over the years again and again. And I've done that conservatively. That's the power of options. When options are giving you 300, 500, 600% returns, it's okay to sacrifice some of that return to me just to not have red in my account or drawdowns. So that's what I do. So if we can go to the next slide, then I'll be able to show you. So here's an example of a recent trade that we just did. But first, I'm going to talk about what's in yellow at the bottom here. Because Mike only gives us the best setups or the most high probability setups. Now, these per setups are usually on 1-2 setups, so expecting a third wave. Sometimes it'll be a 1-2 and then a smaller 1-2. So you'll have nested 1-2 setups. Those are very reliable. So Mike is giving us not only the most reliable trades, but he's selecting only the highest probability out of those and giving them to us. I think that's the reason why this whole thing works. Because most of Mike's trades are up over 60% at some point in their lives, and usually early on into the trade. Because when you have a 1-2-1-2 setup, there's usually some momentum to the upside building, and we get a velocity move. When we get that velocity move, if we're up 60% or more, I just do not see any reason to let that trade expire worthless at that point. So what I do is I capture some of the gains. If you look at the last entry on this table, we sold out one day before the final day, and we made 80% on that trade, almost 81%. I sell out between 60% and 150%. I'll take out a third to a half of the position. That way we get most of our cost out. And then I don't have to worry about so much whether the trade works or not. Because if most of his trades are up over 60% at some point, that means some of them won't be. And so what I do is I factor in the fact that some of these trades will be losses. I mean, that's just part of the system. And I think a lot of traders or people that come in Mike's fix room uh, just sort of forget that fact, especially after we have a few winners. But losses are part of the system. What I try to do is just minimize those so I don't have to deal with them. So if you see then, after we took out 80% on that trade, the next day we exited in two tranches for 343% and 327% for the other half of that trade. We went out in two ace. And so we're catching a lot. Sure, half of our trade we sold out for 80 instead of 320. So we did lose some of the profits there. But when you're making 327% on a trade, as far as I'm concerned, that is a trade-off that I'm willing to take. There are a lot of traders in Mike's room who like to just take the trade to the end. And if they're making that in an informed if they're making that decision as expert traders in an informed way who understand their risk profile, then there's nothing wrong with it. But I think there are some traders or just some people who have full-time jobs who would rather just have a little more hand-holding. And so for that, we have a trade table where we give exact entries, exact exits, and hopefully, well, I'm pretty confident that anyone who follows this will be able to duplicate the success that this group of traders that follow Mike for years have been able to have. The only reason they wouldn't is if they weren't being consistent with the system, and that is up to them. But we're putting the system out there. If you want, you could just copy the trades that we take when we take them, and you should match the performance we have. I'm personally setting aside $20,000. So I'm starting as a small trader again, just to show that I can grow this account. And now, after a couple months, I guess you can go to the next slide now. But after a couple months, we've had some what I consider very good returns. In the first month, we had an 8.61% return. The second month is over now. And so we've had about a 6% return. If you, and it's, I just, I guess I could see why some people would think that that's not very exciting. But if you spread this out over 6 months, then if you look at this table, you'll see that after 6 months, your 10,000 is 16,000. I plan on making 60% on my account size every year at a minimum. I like to double my account every year, and sometimes I've done better than that. Every year is different, so we can never promise the return you're going to get in a single year. But if we follow the system, your drawdown should be low no matter what the return is. And I can't sit here and promise a 60% return, but I'm not worried about that. About making 60% on the account size. So if I started with my $20,000, I would expect there to be 20,000 plus 60%. So at least about $32,000 in that account at the end of the year, hopefully more. So I think a lot of people think of these trades as just trades, or maybe some people aren't taking it seriously enough. But when you don't do that, it just does not work as well, from my experience and from Mike's experience, which is why he brought me on. And so from now on, we're taking that group of us that profit every year from Mike. We're making sure that everyone else in the room sees that same success, and it's working so far. That's all I have. And I just want to say that it might not be exciting to make 8.61% in a month, but if $10,000 turns into 16,000 in 6 months, that is exciting, I would say to anyone. So it's a wonderful approach. Mike is a wonderful analyst, and that's all I have to say.
I think so. And just to add to that, the 8.61%, again, these numbers are taken at a very conservative level. So, Lou's approach really is his first and foremost concern is risk mitigation, is managing risk, having very low drawdown on the account. If we looked at the trades over this first particular month, I think the lowest drawdown we had was less than 1% drawdown on the account, if I remember correctly. But that's his approach, is risk mitigation, managing risk, and that's the first approach. And when looking at these trades, and from my experience, successful traders don't go into a trade looking at how much they stand to gain, but looking at how much they stand to lose. And that's the approach that we try to take, and we really trying to emphasize more and more as we've grown the service and educated traders on their own particular trading. It's not how much you're going to make on a particular trade that you really need to be focusing on, but how much you stand to lose. Because you can't trade if you blow up your account, and it's very easy to do that. In any type of trading. If you're just taking on too much risk. So risk management is paramount, and it's something we really try to emphasize in the room. And I think it's something that is somewhat unique to us. Again, I've been around this for a long time. I've seen a lot of different services and a lot of different analysts out there who really always, you want to tout your gains, but really the key is to being successful at this over a long period of time is really, really managing risk. Risk management is by far the most important aspect of being a successful trader. It's far more important than the analysis. We do a very good job of analysis using light wave theory. Really helps us identify option setups in particular, but managing risk is equally, if not more important than being right on the trade setups. So that takes us to the end of our presentation. I'll just kind of end it with some comments from some of the traders in our room over the years, and these are just a few of the many that we have. And I'll let everyone kind of take a look at these. We'll open up to any questions that you may have. We're happy to go back over any slides that we reviewed previously for any questions for either myself or Lou.
I can see some if you want me to read them.
Sure.
How do you decide how long it will take to reach wave 4?
Okay, let me go back to that chart. Okay, so, and this is one of the difficulties in trading options. There's really no guideline in regards to or I would say rule in regards to timing of Elliott wave analysis, except for one particular pattern, which I'll discuss in a little bit. But as far as the wave 1-2 setup, there's really no particular rule in regards to timing. There are some guidelines and some things that I've anecdotally noticed over the years. And that typically is the length and time of the wave 1 and the length of the time of the wave 2. So typically, I like to give enough time of our wave 3 as the wave 2 took. So that's, and I like to try to give as much extra time as possible. And so when we lay out our option strikes, what I'll do is, let me go back to this screen. I will lay out 3 different dates. And if it's a shorter term trade, it'll be dates by single days as we have our everyday option expirations on the index ETFs. And I want to try to give as much time as possible on a particular trade. But I still want to see a sizable enough return that it makes the trade worthwhile. So on the 1-2 setup, when we're looking for this wave 3, there's really no fixed rule that we look for, but I'm looking at certain how long this wave 1 took, how long this wave 2 took, and I want to try to get at least the same amount of time from the beginning of the wave 1 to the end of the wave 2 is typically what I'm looking for. So I want to give at least that much time, and I want to try to give a little bit of a buffer in case this wave 2 takes longer than expected. So in this particular case, it moved up very quickly. It moved up the next day. But I typically like to give enough time to give a little bit of a buffer in the particular trade on the 1-2 setups. Now, there is another trade pattern in Elliott wave that actually does give a price and a time target. And this is a very unique pattern, and really it's the only pattern in any technical analysis that's reliable in giving price and time targets, and that's an ending diagonal pattern. We didn't review this in this presentation just for the purposes of time, but it's a pattern that I am always on the lookout for, especially when trading options. And these types of patterns are the ones that we can see the greatest returns on, because we have the highest level of confidence that we can take the trade all the way to the target. So this pattern here is that we saw into this low here is actually very close to an ending diagonal target. And what an ending diagonal is, I'll just use this as an example because it actually does look very similar to an ending diagonal. So I'm going to use this as an example. So ending diagonal is a corrective wave structure. We have an A, B, and a C. And then we still have the C wave of this structure is 5 waves. We would have 1, 2, 3, 4, and 5. Okay, so this is what we call an ending diagonal structure. And under this structure, we have all of our waves overlapping with each other. So we have our wave 1 and 2 here, and we'd have our wave 3 and 4 here. Typically in Elliott wave, our wave 4 does not overlap with the end of the wave 1. In this case, in an ending diagonal pattern, it does. So when we see this type of pattern develop, what we can look for, what we typically see is a very sharp reversal to the upside back to the origination point of that ending diagonal. So in this particular case, if this was an ending diagonal, we would say our origination point would be here at the 476 level, which also coincides, gives us confluence with our wave 1-2 setup here. So this would be a very high probability setup that we're looking for to move very quickly back to the origination point in less time than this diagonal took to develop. So in this particular case, this began on looks like 1-1 into 1-5. So we would have the reversal should take less than 5 trading days for this to reverse. And in this case, I think this did end up falling through up to that origination point. So this is one instance that we do have a price and time target that are highly reliable. And these, again, are always setups that I'm on the lookout for when trading options, specifically because we have a really well-defined price and time target, which, again, I don't know any other analysis method that can give you reliable price and time targets. And again, we can then narrow down and use a shorter dated strike, which gives us a higher return versus using something further out. If we would have went out two further days on this trade, we would only got 224% versus 500% using the shorter dated strike based on our knowing that we have a time target on this particular ending diagonal setup. So again, I didn't review this in this presentation, but these are setups that I'm always on the lookout for when I'm doing my analysis and these can see very outsized returns. Oftentimes we'll see in excess of 500%, upwards of 1,000% returns on these ending diagonal setups. So these are great setups, and they give us a price and time target that's very well defined. Our 1-2 setups are a little bit less reliable. We need to be a little bit more conservative on our timing. We try to give a little bit more room on the timing, and we also are a little bit more cautious when we do move in our direction, especially when we're hitting that minimum target level. We always want to be very cautious about taking profits. But if we have an ending diagonal setup, we can be a little bit more, give a little bit more leeway to the trade, as we know that once an ending diagonal confirms that it has reversed, we very often will see origination back to that, move back to the origination point of that ending diagonal. So these are very highly reliable setups that we're always on the lookout for when trading options. So, I see the chat now, so I'll read the next question. How do you decide option expiration date? Okay, so again, it's based on the time. I think I just reviewed that, answered that question. We try to go out as far as we can to give enough leeway for corrective wave action to take a little bit longer than expected. Again, we have an ending diagonal setup as such. We can lay our strikes out to 100% of time of the diagonal. And as Lou noted, he typically will take a little bit longer dated strike just to give a little bit extra cushion in time in case the move takes a little longer than expected. So he'll sacrifice some returns just for the safety of having a little bit more time on that particular option. About how much time does it take to trade the TCA plan each week? Lou, do you want to take that one?
Okay. Um, there's there's also another question that says, on the conservative approach, how many trades a month are assumed in the example? And that example assumes 4 trades a month, which I would say is definitely standard lately. And that makes it about 1 trade a week. So Ben, back to the original question about how much time does it take to trade the TCA plan a week? As far as making the trade goes, if we have 4 trades a month, then the average would be 1 trade a week. I tell people, because the most common thing to happen is for Mike to put out a trade more towards the close. So I tell people, if you check in the room after the open and you check in the room uh, before the close, and if you can swing it, if you could check in around 1 or 2 o'clock in the afternoon, so 3 check-ins per day would be sufficient to make sure you don't miss anything, and the actual trade frequency would be maybe 1 a week. I mean, sometimes they come in spurts, but that's what I think the time commitment would be to check into the room 3 times a day, at least 2 times a day.
And we also have alerts set up to where you can get the actual trade alerts sent to your phone via text or push message, as well as emails as well. So if you're not at the screen at the time of a trade actually executes, you have the ability to have that alert pushed out to you.
And then someone asked if we trade options only or do we trade futures? I'll let you take that.
So the setups that we have can be used for options, or sorry, can be used for futures. They can be used to trade the straight index ETFs. That's certainly something that some of our members do. So in this particular setup, it would be the 1-2 setup. I don't lay out the actual stops that you would be placing under this particular setup. So you'd have to know the very basics of Elliott wave to know where you want to put your stop. In this particular case, it would be under the start of this wave 1 here. I will note that there are times when our initial trade setup will invalidate, and the trade still ends up working out, giving our all or nothing approach. And the reason for that is in Elliott wave, we will always have an alternate count. We'll have a count that is kind of the backup count. And when I take these trades, I usually like to make sure that I have my backup count is going in the same direction as the primary count. So let's say that in this example, this was a 1-2, and this trade, let's say it moved down a little bit lower. So my alternate count would have been here, that this would have been a wave 4. and then a wave 5 of an ending diagonal. So we still may have moved up in the time that we needed, but we would have invalidated the initial trade setup. So there are people who use our system, just trading straight shares. I don't lay the stops out. So again, you'll have to have some analysis, some basic understanding of Elliott wave to know where you want to lay your stops out. But yeah, you certainly could use the setups for trading straight shares or futures. The conservative approach example, the maximum at risk would be $500. This is going to depend on your account size. So if you have a $20,000 account and you want to risk 2.5% of your account, then yeah, you'd be at $500. But if you want to risk 1.5%, you'd be at a lower amount. If you want to risk 5%, you'd be at a higher amount. It really depends on what your personal risk tolerance would be. And if you have $1 million account, then that number would be, greatly increased. It depends on how big your account is, what your goals are, how much capital you're willing to put at risk. Again, these numbers are going to vary from individual to individual. We're using a $20,000 account example at 2.5% per trade. So yes, that would be a $500 maximum at risk. But that would be it. So if you have a $20,000 account and you have a 2.5% risk tolerance, at any one point in time, you're only risking that $500. So if the market crashes 25% overnight, and we are long the setup, for example, you're losing $500. You're not losing any more than that. So that's how we structure the system. So you're not having to worry about spreading out your entire account over a great number of different instruments and having any kind of risk in the market. Based on your entire account being allocated to the market. You're only accounting a very small fraction of your account to the market at any one point in time. So your exposure is limited in advance. So it really is a very effective way to manage risk, especially in what we're looking at. Our opinion of the market over the longer period of time is that we are expecting a larger corrective structure to develop over the next several years. And so I think this is my opinion is this is going to be one of the safest ways to continue to outperform the market in any type of market, especially when the market's going down. Because again, we're trading both sides of the market. It doesn't matter to me if the market's going up or down as long as it's moving, and I can identify patterns. We are agnostic as far as which way the market goes, as long as it's moving. And so again, that's our goal. I think it's a very safe and effective way to manage risk. Do you want to add anything to that, Lou?
No, that's fine. I mean, I would just add that, um, well, let's say in your example that $500 at risk is the appropriate amount. As the account grows, that $500 per trade. So let's say you recalibrate every month. If you made X amount of dollars, maybe you can increase the $500 to 550 a trade, then 600 a trade, and it will accelerate the account growth. You could also reduce if the account goes down, you can reduce the 500 a trade to 490 a trade, 480 a trade, and that slows any count blow up that would happen. It prevents that from happening. So that's just another element to the sizing. Once you get the sizing down correctly, you could adjust it as you go, and that helps you on the upside and on the downside.
So the next question is about how much time passes between enter and exit. Typically, our trades are 3 to 4 days, I would say, on average. There are some times when we take a shorter position, maybe next day. There are some times when we take a longer position, maybe 2 weeks, but they're usually on the shorter durations. So, and usually we know fairly quickly if the trade is going to work or not. But on average, I would say it's 3 to 4 days that we're in a trade. But there are certain instances when we'll have a longer trade setup in place that takes 1 to 2 weeks. But that's usually the longest that we like to go out. And that just is what has worked well for me over the past. I don't typically like to go too far out on the trades. because it allows me to know when I'm wrong quickly and move on to the next trade and not be stuck in any particular trade setup. So and it allows for compounding of our gains more quickly as well. Let's see. Are the markets liquid enough for each index you trade where entry and exit price is not affected too much? We all end up making the same option trade. Generally speaking, yes. So what we've seen as we've grown, the equity ETFs are liquid enough in the options market to where it really doesn't affect the price of that strike too much. There are some of the more instruments that we trade, like the VXX, they're a little less liquid, or we do trade some sector ETFs as well. In those instances, when everybody jumps onto the same strike all at the same time, we will see a temporary inflation of the price at times, but the vast majority of the time that will not last too long. The price comes back to an appropriate entry price in that instance. And there's also always the option to take a strike that's one price below or above the strike that we took, and the returns usually aren't affected all that much. So it hasn't been a major issue so far on the surface.
Someone asked, are we only trading naked calls and puts?
Yes, so we're only doing straight, very simple, basic option trading. So buying calls, selling calls, buying puts, selling puts. Very basic. We don't do any spreads or any type of advanced option trading in the room. We do have some members who will do that. So they'll take what I'm laying out as far as what the options are, and they'll do a spread on it, or they'll do a more advanced type of a option strategy using the basic option play that we're doing. But we keep things very, very simple. So anybody, with very limited option experience can follow us along. And that's what we've seen. So anybody new to options is a great way to learn how to trade them, because again, it's very simple trading in this service. Anybody can follow along, and it keeps things simple. Let's see. Can you tell us current trade you have on? Recent price action is fresh on our minds. Help reflect how you called it. Sure, we can do that.
That's hard because we just closed one and we just opened XBI.
Yeah, yeah, we can go over it. Let me pull this chart up. I'll pull the actual chart up. I'll move this over, see if this, let's see, actually, I think I have to reshare the screen. Let me see if I can do this. Move to a different screen. We're running low on time here, but we just recently closed out a GDX put trade. I'm probably not going to be able to share the screen, just time constraints. We recently closed out a GDX put trade that we were short GDX 2 days ago. We closed out some of it yesterday, and the remainder of it today. Just over 100% is what we gained on that one. We are currently in XBI, which is the biotech ETF, sector ETF, and we are currently short that via puts, and that trade is currently on right now. As Lou mentioned, we recently closed out the SPY trade that was in the previous screen. I'm frozen up here. I can't get back to it at this point. And we also currently have a short Russell 2000 trade on. It's a little bit longer. It's got 2 weeks out on that one as well. So those are some of the recent trades that we've recently closed out and are currently in. But the GDX trade was a 1-day trade, so we bought the puts on, was it Friday, Lou? We closed them out yesterday and today. And the XBI we opened today. The SPY trade, as we saw on the other screen, was see if I can get back to that screen when that was. There it is. SPY was puts. So yeah, SPY
May 6th.
puts.
It closed.
5th to 6th. So again, this was a 1-day trade. So we put them on the 5th and we close them out on the 6th. And we close out some of them on the 5th, same day. We closed some of them out on the same day because we moved down quickly on this. So those are some of the recent trades that we're in. So we're currently have a leaning short right now. Equities is where I'm leaning. But we'll see how things work out in the next few days and make adjustments as needed.